Warren Buffett's fortune began with just $1,000, earned through teenage side hustles like selling chewing gum door to door. Today, that small sum has snowballed into more than $165 billion. It is a common assumption that he achieved this simply by finding a single stock-picking formula in the 1950s and repeating it for 80 years. But the strategy that generates millions often fails when you need to deploy billions. There simply aren't enough small, discounted companies in the world to absorb the capital Buffett now manages. To reach the ranks of the world's wealthiest people, he had to abandon the very rules that made him successful as a young man. This journey to $165 billion was defined by a total professional reinvention. He was forced to overhaul his investment principles every time his success outpaced his existing methods. In the early 1950s, Buffett followed the strict discipline of his mentor, Ben Graham. He hunted for deep value, searching the market's bargain bin for unloved companies trading for less than the value of the assets on their books. This was cigar butt investing. The goal was to find a business that was nearly spent, but so cheap it still offered one last profitable puff of value before disappearing. This chart shows the raw math of this era using the Sanborn Map Company as an example. The market priced the dying map maker at $45 a share, but Buffett realized the company held $65 per share in hidden cash and investments. He saw a $20 gap of guaranteed value that Wall Street was simply ignoring. Buffett bought enough of the company to join the board and eventually forced management to repurchase their own shares at that $65 mark, locking in a 44% gain for his partners. But this strategy required a high-friction cycle of hostile takeovers and constant target hunting. Buffett found himself burdened with the actual operations of failing businesses, most notably Berkshire Hathaway, a dying textile mill he bought in a moment of anger after the CEO tried to cheat him out of a few cents per share. While picking through corporate scraps made him a millionaire, babysitting dying industries was a dead-end strategy for building a global conglomerate. By the late 1960s, a long bull market made cheap bargains scarce. More importantly, Buffett's fund had grown so large that buying tiny, distressed companies no longer provided a meaningful return on his total capital. His partner, Charlie Munger, challenged the idea that a cheap price was the only metric of a good investment. He argued that it was better to pay a fair price for a wonderful company than a wonderful price for a mediocre one. The acquisition of See's Candies in 1972 became the first real test of this new philosophy. The financials were a shock to Buffett's bargain hunting instincts. The seller wanted $25 million for a company with only $8 million in physical assets. Paying 3 times the value of the actual equipment and factories felt like an enormous risk. Munger focused on the brand moat, the intangible power of a name that customers trusted. See's could increase its profits simply by raising prices every year, a power that factories alone couldn't provide. This defensive moat justified the premium price. See's eventually delivered more than $2 billion in lifetime profit to Berkshire Hathaway. It proved that investing in durable, high-quality brands could scale in a way that buying tangible, dying assets never could. Throughout the 1980s, Buffett applied this moat strategy to massive global brands, hunting for elephants that could absorb his billions in growing cash. In 1988, he spent $1 billion on Coca-Cola, recognizing it as a dominant global brand that would continue to grow regardless of short-term market crashes. By the 2008 financial crisis, the scale of his capital was so vast he acted as a lender of last resort. While the markets panicked, Buffett injected billions into titans like Goldman Sachs and General Electric, securing preferred terms that smaller investors could never access. His final major evolution occurred in 2016. After decades of shunning the technology sector, Buffett began buying tens of billions of dollars worth of Apple stock. He didn't see Apple as a tech company, but as a consumer brand with a sticky ecosystem. The integration of hardware, software, and cloud services created a new kind of moat that kept customers loyal and ensured recurring revenue for decades. Applying his classic brand moat logic to a modern tech giant allowed him to add tens of billions of dollars to Berkshire's balance sheet in the 21st century. The mathematical result of this long-term strategy is best seen in his initial 1988 bet on Coca-Cola. Today, Coca-Cola pays Buffett roughly $700 million in cash dividends every single year. He earns more than half of his total initial investment back in cash every 12 months, simply by holding the stock. The Oracle of Omaha now sits as the manager of a $165 billion conglomerate, overseeing an empire built on these evolving principles of quality and brand power. Buffett's fortune grew because he relentlessly adapted his strategy to fit his rising scale, letting 8 decades of patience turn necessary changes into extraordinary wealth.